Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Kirby stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Kirby is the largest tank barge operator in the US. The company transports petrochemicals, black oil, refined petroleum products, and agricultural chemical products by tank barge. Kirby also owns and operates 8 ocean-going barge and tug units transporting dry bulk commodities in the US. The company is a service provider for medium-speed and high-speed diesel engines, reduction gears, and other products for marine and power generation applications. It owns and operates 1,025 inland barge units with 22.9 million barrels of capacity and an average of 255 inland towboats, as well as 31 coastal tank barges with 3.1 million barrels of capacity. In addition to all of that, it has 29 coastal tugboats, 4 offshore dry bulk cargo barges, 4 offshore tugboats, and 1 docking tugboat. The company is headquartered in Houston, Texas, and was founded in 1969. The ticker trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 4.1 billion market cap. They're trading at $68 a share, and they have 60 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 2018 to 2019. Then it's been pretty steady after that. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 18 and 19, negative in 2020 and 2021. Revenue is the sales for the company, and that's been declining. It was $3 billion in 2018. It's down to $2.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was about $400 million, lower than 2018, 2019, and 2020. Their gross margins are 17%. That's gross profit over revenue. Much worse than their industry of 52%. And their net margins are negative since they have negative net income. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that's positive every year, but it's been declining each year. They paid $42 million of interest on their debt, which is lower than prior years. And the reason they have negative net income in 2020 and 2021 was this large negative in other income and expenses. They passed through lots of impairments. An impairment is when you decrease the value of an asset on your balance sheet and pass through a loss onto your income statement. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. This is their income statement from their 10K. $1.3 billion from marine transportation, $900 million from distribution and services. Here's a little further breakdown of their revenue. $1 billion from inland transportation, $300 million from coastal transportation, and in their distribution and services unit, $578 million from commercial and industrial, $345 million from oil and gas. Their cost of sales is $1.7 billion, selling, general, and administrative expenses $267 million. They had $36 million of taxes. This does not include income taxes. Income taxes is down here. $213 million of depreciation and amortization. They have lots of impairments, $341 million. Impairments are non-cash items. These are write-offs of assets they purchased years ago. And they had a $5.8 million gain on the sale of an asset. Since it's negative, it's a gain because it's in the expense column. So they had an operating loss in 2020 and 2021. They had a gain in 2019. But you should really strip out the impairments. If you do that, they have an operating gain in 2020 and 2021. Their earnings per share in 2019 is $2.38. Their loss per share is $4.55 in 2020, and the loss is $4.11 in 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They do generate a healthy amount of cash flow each year. Then you have CapEx, investments in property, plant, and equipment. They spent $98 million in 2021. Operating cash flow minus CapEx gives you your free cash flow, and they are cash flow positive each year. They added $500 million of debt in 2019, paid down $125 million. So they increased their debt load $375 million that year. They increased their debt load $100 million in 2020, and they decreased their debt $60 million in 2021. They do not pay a dividend, and it looks like they don't really buy back stock. So they're just investing the money back into the business. And you can see they made a bunch of acquisitions in 2019 and 2020. Their investing cash flow was over $450 million both years. CapEx is part of investing cash flow, and you can see their CapEx was a lot lower. So the rest must have been acquisitions. Same thing in 2018. This is the operating section on their statement of cash flows. And the way you calculate operating cash flow, you start with your net loss or net income. Then you add or subtract the non-cash items on the income statement. We add back $213 million of depreciation and amortization. We add back that impairment of $341 million. So even though they reported an accounting loss of $247 million, they actually generated over $320 million of cash flow. Same thing in 2020, an accounting loss and a big gain. In 2019, they reported a net profit of $143 million, but generated over $500 million of cash flow. A big reason is all the depreciation and amortization. They also had a cash inflow of $123 million of inventory. That means they sold a lot of inventory in 2019. In 2020, they had a cash outflow of $19 million on inventory. That means they purchased inventory that's sitting on their balance sheet. When they actually use the inventory or sell the inventory, then they'll take it off their balance sheet and put it onto the income statement, and then it'll be a cash outflow. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And both look pretty good. Their revenue is a bit up and down. You would like to see the revenue go up over time. This has been pretty flat since 2015. They are generating a good amount of cash flow each year, and that's what you need to run a business, cash flow. This is their investing and financing sections on their statement of cash flows. In their investing section, they spent $98 million in CapEx. They spent $9 million in business acquisitions, and they received $51 million from the sale of an asset. Last year, they spent over $350 million in acquisitions. The year before that, $260 million. So that's where a lot of their money is going, to acquire other companies. In their financing section, they paid down $248 million on a credit facility, and they paid down $60 million on debt. So in their financing section, they had a cash outflow of $311 million. Last year, they had a cash inflow of $97 million because they added $250 million on that credit facility, the same facility they paid down in 2021. This is the equity section on their 12/31 balance sheet. They have $2.9 billion of equity. They raised $850 million from selling their business, and they profited $2.3 billion from running their business. They also bought back $295 million of common stock. When a company buys back common stock, they take it off the market and put it onto their balance sheet as treasury stock. So it looks like a pretty healthy company so far. Let's look at the capital structure. $2.9 billion of equity, $1.4 billion of debt. They're 68% equity, 32% debt. This blue line is their equity balance since 2015. This red line is their debt balance. And each year their equity balance is a good amount higher than their debt balance. So it looks like they have a pretty solid capital structure. I gave them the highest whack on Finbox, 7.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $4.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.3 billion. We divide that by 60 million shares, and we get a calculated stock price of $72. They're trading at $68, so they're trading at a 6% discount. It's a buy according to the model. Their revenue projection for 2024 is $2.9 billion. Their revenue projection for 2023 is $3 billion, and their revenue projection for 2022 is $2.7 billion. and I had their revenue slightly declining in 2025 from 2024 to be conservative. They convert on average 8% of their revenue into free cash flow. So I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. So it looks like the company's trading pretty close to intrinsic value. Once again, Simply Wall Street is on another planet. Their valuation is 151. They're saying the stock is 56% undervalued. 4 analysts priced this stock and the average price target is $80. All 4 analysts are saying the stock is undervalued. Here are some of the main products they ship on their waterways: crude oil, bunker fuel, residential fuel, propane, butane, natural gas, ethanol, naphtha, jet fuel, gasoline, ammonia, ammonium. So you can see they ship lots of products. And it's really hard to ship these products. Anybody can ship something like a couch or a TV, but in order to ship this type of liquid, it's not easy, it's very risky. Because as you know, it's toxic. It's a lot easier to ship a non-toxic liquid. This is their stock price the last 5 years, so it's pretty much flat in 5 years, which is not a great sign. The stock fell off a cliff like lots of stocks in March 2020. The price has pretty much doubled since that point, but if you bought it before March 2020, there's a decent chance you're down. Their stock is down 4% in the past 5 years. These 3 stocks are the large marine shipping companies in their industry: ZIM, Starbulk, and MATX. All of these are up 200 to 250%. They have a beta of 1.4, so the stock moves about 1.5 times the market. It's up 10.5% in the past 52 weeks, while the S&P is up 6%. The 52-week low is 48, the high is 75. And the stock is trading above its 50-day and 200-day moving average. 600,000 shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 97% are held by institutions, and 3% of the shares are shorted. They've done 2 stock splits in their history. Way back in 1981, they did a 10-for-1, and in 2006, they did a 2-for-1. Their employee count went up a lot from 2016 to 2018, but the number of workers they have has been decreasing slightly since that time. They currently employ 5,100 people. If you invested $10,000 into this company 10 years ago, you'd be at $10,500 today. That's only a 5% return. But you can see this stock is pretty volatile. It definitely moves around a lot. The CEO's salary in 2021 was almost $1 million, and their total compensation package was almost $6 million. In the past 12 months, 10,000 shares have been purchased by insiders, but a lot more shares have been sold by insiders. Every quarter, a few people seem to sell. Here's a list of all the insider buying and selling, the date, the person, the number of shares, and the price. Barry Davis is doing well. He bought at $53. The stock is up to $67 today. Most people sold at a pretty good price. A bunch of people sold above today's price. Even back in May, some people sold above today's price. But a few people sold in the 50s. They may have been better off waiting a little bit. A good sign is seeing high institutional ownership. 97% of the stock is held by institutions, 2% by the general public, and 1% by insiders. The biggest shareholders: Vanguard at 9%, BlackRock, Eaton Vance, Fidelity, and Diamond Hill. Let's look at their financial ratios. We can't look at the PE since they have negative net income. If we strip out their asset impairments, they would have positive net income. That's something to consider when analyzing this company. They have a good price to sales of 1.8, that's stock price of a sales per share, better than the market median average. A good price to book of 1.4. They have lots of fixed assets on their balance sheet, and their price to free cash flow is 18.3. That's stock price over free cash flow per share. Let's look at their non-current assets. Their property and equipment is $5.4 billion. Marine transportation is $4.8 billion. Land, buildings, and equipment is $600 million. Then we have to depreciate that, so the book value is $3.7 billion. Book value is the value reported on the balance sheet. The value of the assets they lease is $168 million. They invested $2.1 million in their affiliates. They have $439 million of goodwill. Goodwill is the premium you pay when you acquire another company. $268 million is from marine transportation, $171 million from distribution and services. Goodwill is not amortized like most other intangible assets. It's impaired at least annually. So we can see an impairment for $219 million in 2020, another impairment for $627 million. You could decrease the value of your goodwill on your balance sheet, but you cannot increase it. The only way goodwill goes up is when you acquire another company for more than it's worth. When they acquired Savage Acquisition, they added $81 million to goodwill. When they acquired Convoy, they added $10 million to goodwill. Both of these acquisitions were in 2019. They report $60 million of other intangibles. When they acquire another company, they have to value that company's contracts. That's an intangible asset. They also have to value those companies' customers. This company reports other intangibles include trade names, non-compete agreements, and liabilities for leases and contracts. And the last thing in other non-current assets is $48 million of other. Let's look at their non-current liabilities. They have $1.2 billion of long-term debt. Long-term debt is debt due beyond 12 months. They have $1.9 million due this year, $350 million due next year, $315 million due in 2024, and $500 million due after 2026. They report $574 million of deferred income taxes. Here's a breakdown of that $574 million. $13 million is related to their inventory. They have $180 million of deferred tax assets. A deferred tax asset will help decrease the company's taxes in the future. $90 million of that is losses carried forward from prior years. $66 million is tied to goodwill and other intangibles. They have $754 million of deferred tax liabilities. A DTL will increase a company's taxes in the future. Since their DTL is higher than their DTA, they report this $574 million on their liability section of their balance sheet. In the DTL, $655 million is property taxes, $83 million in state taxes, and $15 million in other. They owe $160 million on their operating leases and $71 million of other. Their other long-term liabilities decreased 46% from 2020. This is due to the amortization of intangibles, also a decrease in pension liabilities due to improved funding, also the payment of payroll taxes under the CARES Act. They have a low return on invested capital of 1.5%. They can cover the interest payments with their operating income almost 2 times. They have a negative ROE since they have negative net income. They have a good current ratio of 1.8. That's current assets over current liabilities. And their quick ratio is pretty good as well at 1.2. Let's look at their current assets. $35 million of cash. They have $418 million and $150 million in accounts receivables. This is how much money is owed to them. They have $330 million of inventory. Inventory is carried on the balance sheet at cost or net realizable value. Cost is the original cost you paid for the inventory. NRV is the amount you can sell the inventory today in the open market. Some companies report inventory in just one line item. Others report it in 2 line items like this one. Some report it in 3. 71 million of their inventory is work in process. That means they plan to turn this inventory from a raw product into a finished good. A majority of their inventory is finished goods, 261 million. This is pretty much inventory they can sell as is. If they had very little in work in process, that could indicate the company expects limited demand in the future and sales may decrease. Or it could mean they're having difficulty getting supplies from their vendors. There's more information on a company's inventory in their 10K. And they have 70 million of prepaid expenses. Prepaid expenses increased 21% from 2020. This is mainly an increase in the price of fuel, also the reclassification of certain equipment held for sale. Let's look at their current liabilities. 1.9 million of banknotes. That 1.9 million is a debt that's due in 2022. 200 million of accounts payable. This is how much money they owe their vendors. They have a bunch of things in accrued liabilities. An accrued liability is when a business has incurred an expense they haven't paid yet. 11 million of interest, 111 million of insurance premiums, 39 million of employee compensation, 44 million of taxes, and 29 million of other. They owe $34 million on their lease payments over the next 12 months and 73 million of deferred revenues. Deferred revenue is when a company receives an advance payment for a product or service they're going to deliver in the future. Their deferred revenue increased 60% from 2020. That's mainly from when they receive deposits on equipment they're going to ship this year. When they ship that equipment, then they'll remove this dollar amount off their balance sheet and book it as revenue onto their income statement. In 2021, they generated $224 million of free cash flow and they have $460 million of working capital. So it looks like the company's pretty well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 34 companies in the same industry as Kirby, and if Kirby has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they have a better debt to equity ratio than average. They do not pay a dividend. Almost everybody on this list does pay a dividend. They rank second in market cap at $4 billion. Zim is the only company that's bigger. Their price to book is a little worse than average. We can't look at their PE since they have negative net income. Their price to free cash flow is a lot worse than average, and their price to sales is a little worse than average. And their revenue has been declining the past 3 years, and they have negative ROA and ROE since they have negative net income. So to summarize, I have them trading at a 6% discount. This seems like a pretty steady and safe stock, although there hasn't been much upside the past 5 years, unless you happen to catch it in the beginning of 2020. But timing stocks can be really risky. So I'm really interested to see how this company performs in 2022 if they hit their revenue targets. I rank their free cash flows revenue ratio as 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.